When you think of making money, you probably picture giant printing presses, hordes of new customers, and a government vault. This is a myth. In 2025, physical cash represents only 3% of the entire money supply in the US and the rest of the world. The remaining 97% are just numbers in bank computers. But the real secret isn't that money has become digital. The real secret is who's typing it. Most people believe that a bank is an intermediary. You make a deposit, the bank takes your money and lends it to your neighbor. This is a lie. Banks don't lend out other people's money. In this video, we'll explore how commercial banks create currency out of thin air the moment you sign a loan agreement. Welcome to the true story of the quiet book. Let's look at the official data. Back in 2014, the Bank of England stated bluntly, commercial banks create money by making loans. How does this work in practice? Imagine you take out a $500,000 mortgage at RBC or TD Bank. The bank doesn't go to the vault to collect other depositors' money. It simply opens your account and writes down the figure, $500,000. At that very moment, the money supply in the economy increased by exactly $500,000. This is called credit creation. In accounting terms, the bank simultaneously creates an asset, your debt to it, and a liability, the money in your account. This money didn't exist a second ago. It was born from your promise to work for the next 25 years and pay interest. So, almost every dollar in your pocket is someone else's debt. If everyone in the world repaid their loans tomorrow, money would simply disappear from circulation. If commercial banks can simply write money, what's stopping them? Why don't they just make trillions? This is where the central bank, the Federal Reserve in the US or the Bank of Canada, comes into play. Their job isn't to print money, but to regulate the price of that money through interest rates and the volume of reserves. We used to be taught the theory of fractional reserve banking. Supposedly, a bank needs to have $10 in its safe to lend out $100. But in the modern system, this rule is almost dead. In March 2020, the U.S. Federal Reserve officially set reserve requirements at 0%. In reality, banks aren't limited by reserves, but capital and profitability. They need to trust that you'll repay your loans. If the economy declines and people stop borrowing, money creation stops. This is the beginning of a deflationary spiral. The monetary system isn't a gold warehouse. It's a giant network of promises that only works as long as we believe in tomorrow.
There's a fatal flaw in this system. The bank creates the principal, but it doesn't create the money to pay the interest. If there are only $100 in the world, all lent at 5% interest, then after a year, the bank needs to pay back $105. But those $5 don't physically exist in the system. To find those $5 for interest, someone else must take out a new loan, and so on, ad infinitum. The system must expand, the debt must grow, and inflation isn't a bug, it's a necessary condition for this kind of mathematics to exist. Before we go any further, let's burn the most popular economics textbook. For years we've been told, in the beginning there was barter. You gave your neighbor a chicken, and he gave you an axe. But that's inconvenient, so people invented money. The problem is that historians and anthropologists like David Graeber have found no society in history that lived purely on barter within itself. Barter existed only between enemies or strangers. Within the village, no one traded fish for shoes right then and there. People lived in a system of mutual obligations. If a neighbor took your fish, they simply owed you the fish. This wasn't recorded in a notebook, but in collective memory. Money wasn't born from the exchange of things, but as a way to measure debt. Money isn't a commodity. Money is a mathematical notation of who owes society what. Let's fast forward 5,000 years to Sumer. Here, in the area between the Tigris and Euphrates rivers, the first true financial system was born. And no, these weren't gold coins. These were clay tablets. Temples and palaces were gigantic accounting centers. Peasants would deliver grain and in return receive a tablet recording the debt. These tablets began to circulate. You could give your clay receipt to someone else to pay off the debt. The concept of interest already existed. If you couldn't repay the temple debt, the amount escalated. This led to entire families falling into debt slavery. Every few decades, new kings would proclaim amargi, complete debt forgiveness, to prevent society from imploding. We see that even at the dawn of civilization, money was a tool for controlling and managing resources, not just a convenient coin in your pocket. A true revolution occurred around 600 BC in Lydia, modern-day Turkey. The first minted coins appeared, the Lydian lion, made of electrum, an alloy of gold and silver. But ask yourself, if gold is already valuable by weight, why would the state stamp it with its own stamp? The answer is simple: taxes. The state needed to support an army. The simplest solution was to mint coins, distribute them to the soldiers, and announce, every citizen is obligated to pay taxes at the end of the year in this very coin. To receive this coin, the peasant was obligated to sell food to the soldiers. The coin became not just a medium of exchange, but a mechanism for forcing people to work for the state machine. The gold standard was born not for the convenience of the market, but for the logistics of war.
While Europe was buzzing with coins, Song Dynasty China realized that transporting tons of copper and gold across the country was madness. This is how Fei Qian, or flying money, was born. A merchant would deliver metal in one province, receive a paper receipt, and cash it in another. The government soon realized if people trusted paper, why bother returning the metal at all? This was the first experiment with fiat money. But the Chinese fell into the same trap we're falling into today. They began printing more paper than the economy had resources to support. The result was the first hyperinflation in history, which destroyed the dynasty. Paper is trust, and trust is the most fragile resource in the world. And so we come to the moment that explains everything that happens in 2025. London, 17th century. Goldsmiths had secure safes for storing gold. Wealthy citizens deposited their metal with them for safekeeping, and jewelers issued paper receipts. Soon people noticed jewelers' receipts were accepted everywhere because everyone knew there was gold behind the paper. Jewelers noticed this too, and they made a brilliant and simultaneously criminal discovery. They realized that no more than 10% of depositors came to claim their gold at any one time. This was the birth of fractional reserve banking. Jewelers began issuing receipts for gold they didn't have and lending them out at interest. They began creating money out of nothing, simply by exploiting the reputation of the gold stored in their vaults. The jeweler became a banker. Thus was born the modern banking system. It is built on the secret that there is far less gold in the vault than paper in circulation.
The history of modern money began not with a royal decree, but with his debts. It's 1694. England is waging a bitter war with France, and the treasury is empty. A group of London merchants proposes a deal. They lend the king £1.2 million in gold in exchange for the right to establish the Bank of England and, most importantly, to issue banknotes backed by this debt. This was a turning point in history. For the first time, a private organization received the right to print money guaranteed by the state. Thus was born the bond that underpins the modern world. The government spends money it doesn't have, and the central bank releases it out of thin air, locking up the debt for future generations. Money ceased to be just metal, it became a legalized promise. In the early 18th century, this new system nearly destroyed Europe. At this time, Richard Cantillon appeared on the scene, a man who not only got rich through financial fraud, but was also the first to describe how new money was changing society. At the time, the world was witnessing the collapse of John Law's Mississippi Company, the first attempt in history to replace gold with paper on a nationwide scale. Cantillon observed that when a government or bank injects new money into the economy, it doesn't make everyone richer at the same time. Those closest to the printing press, bankers, courtiers, and large merchants, receive this money first before prices rise. By the time this money reaches the peasant or artisan, food and rent prices have already soared. This observation became known as the Cantillon effect. It is historical proof that inflation is always a redistribution of wealth from the poor to the rich.
For a long time, the United States lacked a single monetary control center. But history is cyclical. After a series of panics and crises, the Federal Reserve System was created at a secret meeting on Jekyll Island in 1913. This was the apogee of the history of private goldsmiths. A group of private banks gained a monopoly on issuing global currency. While up until this point, gold had somehow limited government appetites, with the creation of the FRS, the history of money became a story of endless credit expansion. By the 1930s, the confiscation of gold from the U.S. population was only a matter of time. The government needed complete control over the ledger without regard for physical metal. At the end of the 20th century, the history of money took its final leap for now. From sheets of paper, it transformed into magnetic recordings on disks. In the 1970s, the first interbank payment systems, such as SWIFT, emerged. Money finally separated from matter and became information. Today, we live in the era of the digital ledger, where 97% of all the world's money is simply accounting entries. History has evolved from bone etchings and Sumerian clay tablets to cloud servers. But the essence remains the same. Whoever controls the ledger controls the planet's real resources. We've replaced trust in gold with trust in algorithms and institutions. The history of money isn't the history of metal, it's the history of how we agree to measure human labor. We started with the debt tablets of Mesopotamia and returned to the digital debt records of today, coming full circle. And what this led to, see our next video.